When top economists warn that we're on the edge of a recession cliff, but you open your brokerage account and everything seems fine, is the market's optimism a shot in the arm, or is it an anesthetic? Hey everyone, welcome to the debate. We have only one goal here: to cut through all the market noise, challenge the prevailing narratives, and help you find the clearest path forward in this confusing market. Without further ado, let's get started.
Ladies and gentlemen, today I stand before you to argue that the United States economy is indeed on the precipice of a recession. While my opponents may point to seemingly positive surface-level statistics, the warning signs are flashing red across multiple indicators that have historically predicted economic downturns. Let me start with what leading experts are saying right now. Just this past weekend, Mark Zandi, chief economist at Moody's Analytics, stated unequivocally, "The economy is on the precipice of recession." This isn't speculation. This is based on hard data from last week's economic reports. The U.S. job market is deteriorating faster than headlines suggest. Yes, the official unemployment rate is 4.2%, but let's look deeper. July saw the worst job growth in years, only 73,000 new jobs when economists expected around 100,000. Even more alarming, the previous month's numbers were slashed by 258,000 jobs in revisions, the biggest two-month downward revision in 46 years. When economists see revisions this massive, it is often a sign the economy has already turned the corner. Manufacturing is in free fall. For 5 straight months, American factories have been shrinking. The manufacturing PMI hit just 48 in July. Anything below 50 means contraction. Factory employment has dropped to its lowest level in 5 years. This isn't just a domestic issue. It signals weakening demand, both at home and from abroad. The current U.S. administration's tariffs are creating a perfect storm for recession. These tariffs act like a massive tax on consumers and businesses within the United States. The Yale Budget Lab calculates this will cost the average American household $2,400 this year alone. But the bigger problem is the uncertainty this creates. Businesses globally cannot plan effectively when trade policies are so unpredictable. This is crushing business confidence and investment, which are the engines of economic growth. Finally, consumer confidence has collapsed. In the U.S., consumer expectations about future economic conditions have hit a 12-year low. When consumers, who drive 2/3 of the U.S. economy, lose confidence this dramatically, they stop spending. That slowdown in the world's largest consumer market creates a ripple effect that will be felt globally, pulling the entire economy down. Thank you, and I look forward to the discussion ahead.
Ladies and gentlemen, thank you for that opening statement. While my opponent has painted a concerning picture, I must respectfully challenge these claims with the actual economic data that shows the United States economy is demonstrating remarkable resilience, not recession. Let me start with the fundamental facts. Yes, July saw 73,000 jobs added, but this is not the economic collapse my opponent suggests. The unemployment rate remains at a historically low 4.2%, within the narrow range it's held since May 2024. For our international audience, this level of unemployment is far below what we typically see during recessions in any developed economy. But here's what my opponent didn't tell you about GDP, the ultimate measure of economic health. In Q2 2025, America's economy grew at a robust 3% annualized rate, crushing expectations of 2.4% and completely reversing the Q1 contraction. This isn't a recession pattern, this is economic resilience in action, something the global economy benefits from given America's role as the world's largest consumer market. My opponent mentions a manufacturing PMI of 48, but what he doesn't mention is that production actually increased to 51.4 in July. Manufacturing represents a smaller portion of today's service-based economy, and services continue to show strength. And looking forward, the argument for recession becomes even weaker. The current administration has already signed into law significant new tax cuts. We're talking about permanent extensions of existing cuts and additional relief for working families. The corporate tax rate could drop from 21% to as low as 15% for companies that manufacture in America. This isn't a government bracing for a downturn. It's a government injecting more fuel into the economy, boosting spending power and encouraging business investment. Let me be clear about what real recession indicators look like. Widespread business failures, massive unemployment spikes, collapsing consumer confidence, and sustained GDP decline. We're seeing none of these. Instead, we see an economy that's adjusting and growing, supported by pro-growth policies. The American economy has weathered far worse storms and emerged stronger. Today's data shows resilience, not recession. Thank you.
Ladies and gentlemen, thank you for that response. My opponent highlights some positives, but let's dig into the real story behind those numbers, because a closer look shows the US economy is weakening, with global ripple effects we all feel. First, that 3% GDP growth in Q2 2025? It sounds strong, but it was mostly driven by a massive drop in imports, down 30% after a surge from tariff fears. Underneath, consumer spending, which powers 2/3 of the economy, slowed to just 1.4%, the weakest in years. That's not resilience, it's a warning. On jobs, my opponent points to the 4.2% unemployment rate, but that is a lagging indicator. It tells you where the economy has been, not where it's going. The real story is that the government just erased 258,000 jobs from past reports, the biggest downward revision in 46 years. This proves the job market was far weaker than we were told. Manufacturing? The PMI is at 48, signaling contraction for the 5th straight month, with factory jobs at a 5-year low. And those new tax cuts? They can't offset the chaos from tariffs, costing households $2,400 yearly and crushing global trade confidence. Consumer expectations are at a 12-year low, and with credit tightening and savings depleted, a downturn is coming. History shows these signs don't lie. Thank you.
Ladies and gentlemen, thank you. My opponent is asking you to look at the economy through a microscope, focusing on a few specific challenges. I'm asking you to step back and look at the whole picture, which is one of fundamental health and resilience. First, let's talk about the American consumer, the engine of the global economy. Yes, spending growth was 1.4% in the second quarter. But let's be clear, that is still growth, not contraction. And here's the key piece of information my opponent overlooked. Inflation has cooled to just 2.7%. This means that for the first time in years, wages are rising faster than prices. This gives households more real purchasing power, which is the fuel for future spending, not a sign of a coming recession. Second, the job market. My opponent correctly calls the unemployment rate a lagging indicator, but when that indicator has been at a historic low of 4.2% for over a year, it shows the economy has an incredibly strong foundation. Recessions are preceded by widespread layoffs, which we are simply not seeing. And while manufacturing faces headwinds, the services sector, which employs the vast majority of Americans, remains robust. Finally, my opponent talks about uncertainty. But let's look at how businesses are actually behaving. Corporate profits remain strong, and business investment is stable. Companies are not acting like a recession is imminent. They are navigating challenges and continuing to invest. So, while my opponent sees weakness, the reality is an economy with a strong labor market foundation, rising real wages for workers, and profitable companies. That is the definition of resilience, not recession. Thank you.
Ladies and gentlemen, throughout this debate, my opponent has done an admirable job of pointing to the one sunny spot in the sky, the low unemployment rate, while asking you to ignore the rapidly gathering storm clouds. But let's be honest, relying on today's unemployment rate to predict the economy is like trying to drive a car by looking only in the rearview mirror. It tells you about the smooth road you've just left, but it won't warn you about the cliff that's right ahead. The reality, as we've shown, is that the cliff is approaching. Manufacturing is in a 5-month contraction. The consumer, who drives the entire US economy, has lost confidence, with expectations at a 12-year low. And my opponent's argument about a strong services sector? Well, when people stop buying things, they eventually stop paying for services too. The facts are clear. The leading indicators are flashing red. Don't be comforted by a look in the rearview mirror. The evidence points to only one conclusion. A recession is not a matter of if, but when. Thank you.
Ladies and gentlemen, my opponent wants you to believe we're driving toward a cliff. But here's the thing about economic predictions. If you spend all your time looking for storm clouds, you'll miss the sunshine that's actually happening right now. Let's talk about that car metaphor for a moment. My opponent says unemployment is like looking in the rearview mirror. But when your unemployment rate has been steady at historic lows for over a year, that's not a rearview mirror. That's your dashboard telling you the engine is running perfectly. And speaking of dashboards, let me read you the real gauges. GDP growing at 3%, wages finally rising faster than prices for the first time in years, and corporate America still making healthy profits. Those aren't lagging indicators, those are the fundamentals of an economy that's working. Now, my opponent mentioned manufacturing challenges, and yes, every economy has bumps. But here's what they didn't mention. The largest part of our economy, services, remains strong, and we've got tax cuts coming that will put more money in people's pockets. You know what causes recessions? Mass layoffs, collapsing GDP, crashing corporate profits, and widespread business failures. We're seeing none of that. Instead, we're seeing an economy that's adapting, growing, and creating opportunities. My opponent predicts doom. I see an economy that has weathered countless storms and keeps surprising the pessimists. The American economy isn't heading for a cliff. It's navigating the road ahead with skill and strength. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.